Okay. But the attendance is good. The attendance is good, 21. Okay, good. We will continue with the terminology like we did last week. We had a proper slide for this one. We were supposed to use a slide, but they just push. What matter is the message. Number 21. These are the terminologies. There's one that we didn't add, swap. Number 21, what we have, it's a Forex broker, okay? A Forex broker, it's a firm or a company or individual. Some of you might not see it very well here, but check on your group. These terms are the same. A firm or a company or individual that provides access to the Forex market, allowing traders to buy and sell. That is a Forex broker. In our case, our broker that we are using is Deriv. Okay. And then we move to number 21, liquidity. Liquidity is the ability to buy or sell an asset quickly without a significant impact on its price. High liquidity indicates more stable price movement, while low liquidity may result in high volatility. What do we mean by that? Let's assume you want to sell your cell phone, the current cell phone that you have. How much can you sell it? Let's say if you are to sell it tonight, like now, if you want quick money, you want to sell it, how much will you sell it?
Maybe just 1.5.
Even 1,000 just to lose to get the money so fast, most.
So fast, yeah, ne? Let's say you want to sell it now, like now as we speak. What are the chances that you will find a client?
Very few.
Very few, ne? So what will happen is, let's say if you want to sell it for 1,000, like now, tonight, if you post it on your status, you might not find a client. And tomorrow, a client will come through, but he might want to negotiate, maybe from 1,000 to 900 and so. You will end up selling your cell phone maybe tomorrow at 900 instead of 1,000. Okay. In a market like selling cell phones or second-hand cell phones or pre-owned cell phones, what happens is sellers cannot sell their things at the price that they want whenever they want. That is, it's called low liquidity in that case. Because you didn't want to sell it at 900 and you didn't want to sell it the following day. You wanted it right there at 1,000, but you can't. So it's low liquidity. In the Forex market, you can buy and sell a currency pair whenever you want at the market price that you intend to sell. So in that case, it's called high liquidity. Do you get the difference? Are we fine there, or I should repeat?
Okay. Yeah.
So liquidity is the ability to sell and buy whenever you want at the price that you want. So in the Forex market, you can wake up and you can sell and buy whenever you want. That is high liquidity. Cell phone market, you can't do that. So it's low liquidity. That is liquidity, okay? And then we have, for those that just joined, you're welcome. Volatility. We have a volatile currency pair, a currency that experiences significant price movement in a short period. Meaning, when the price moves up and down very fast, that is known as low. No, that's known as high volatile. It's volatile. It's a volatile market. Factors such as economic data, geopolitical events, and market sentiments can contribute to volatility. We'll learn more about market sentiments later. But when the price moves up and down very fast, it's known as high volatile. When the price is not moving at all, it's known as low volatile. I do not have MT5 on this laptop, but let me try to access TradingView just to show you low and high volatile markets. I'll teach you TradingView later. This is the website that you'll be using to analyze. You can just simply come to TradingView, then you sign in with your Gmail account. You will click on the menu, product, then super chart. Okay, to go to a chart, super chart. So what we have right now, just as a quick example, can you see the difference here on how the price was moving? If you had to look here, the price was not moving at all. It's like they were making very small candles. We will start with candlesticks this week. But if you look here, the price was moving sharply. So in this case, this is low volatile. This is high volatile market when the price is moving very fast. Okay.
Are you still in, or is it me who is out? I can't
It's
hear
my mic
anything.
that was muted. Is everything fine now?
Yes, yes.
Okay.
Yes.
Yes.
Did you get the definition of slippage, or when was I muted?
No.
Nothing
We
about
can hear you.
slippage.
No, we didn't get it.
Okay, let's take a step back. I was saying slippage, it's the difference between the expected price of a trade, the price that you are expecting to buy and sell, and the price that you actually execute, at which trade is executed. It often occurs during high volatility or low liquidity conditions. Then I move to TradingView to explain, as we speak, the price is where you see a dotted line here. This is where the price is. You can see this line, right?
Mhm.
Let's say if you are to press a buy and sell, your intention is you want to buy and sell exactly at this price. What usually causes slippage, it's caused by two things or more, okay? But in short, it can be caused by the price movement. If you press a buy here, especially during news event, slippage occurs because the price is moving up and down very fast. The time that you click your button, speed matters. Within few seconds, the price might already be somewhere here, up there. So meaning, instead of you buying and selling at the price that you want, your trade can be carried away and be executed at a different price. Let's say at a higher price than you wanted or at a lower price than you wanted. It usually happens during news events because the price is moving very fast. What will happen is you click a buy here, but your trade will only be executed here. So instead of you buying here, you'll end up buying here because the price is moving very fast. Or instead of you selling here, you'll end up selling at a lower price. That is caused by slippage because the price is moving very fast. It's very volatile. So slippage is caused by volatility. Another cause of slippage is network problem. If you are trading with a poor connection network, the time that you press here, your trade can be executed somewhere there. What will then happen is your network is very slow. After pressing, it's loading. By the time it goes through, you might end up selling there or you might end up buying there. So those are some causes of slippage, okay? Or another cause is liquidity. This is not available to us. It's mostly available to big players, people that buy in big volume. Let's say if you want to buy maybe for Euro USD with a 1 billion, but there are no sellers that are available to sell to you a 1 billion at 1 billion. What will then happen is your trade will not go through when you want to buy because there are no sellers. Maybe a few minutes later when there will be sellers available, that is when it will be executed. That is another cause of slippage. Do you understand slippage? Basically, when your trade is executed at a different price than what you wanted, it's slippage. Is it clear there?
Yes, sir.
Okay.
Yes, it's clear, Mr.
All right. Then we move to a bull market. What is a bull market? It's a market condition where prices are rising. When price keeps going up, they keep going up. You probably heard about the word bull run. There will be a time that cryptocurrencies, they just keep buying. On NASDAQ, it like to have bull markets. It like to buy at some point. So when the price keeps rising or are expected to rise in Forex, often refers to a currency that is gaining value against another. So when the price keeps increasing, it's a bull market, okay? Then we have a bear market. A market condition where prices are falling or expected to fall. In Forex, often referred to currency that is losing against the other market. It's actually derived from these animals. You can check bulls versus bears in Forex. If you look at the images, we can switch to images. Mostly you will find it, the famous is at Wall Street, ne? Let's say we pick this image. You'll usually, in the Forex market, you'll mostly see these images of bulls and bears, where a bull symbolizes a price going up, and then a bear symbolizes a price going down. Yeah, this one. This is a common, even in movies, you will see this image a lot. So this is the whole thing. So if you are to read here, the term bull originally meant a speculative purchase in the expected that stock price will rise. The term was later applied to the person making such purchase and so on, okay? So when you are a buyer, you are referred to as a bull. When you are a seller, you are referred to as a bear. You will mostly hear or see when we are giving signal. If we say bulls are in control, meaning which people are in control?
Buyers.
Yes, when we say
Buyers.
yeah, when we say bears are in control, we mean sellers are in control. That is bulls and bears, okay? Then we continue by fundamental indicators. A fundamental indicator It's economic statistics and data points used to analyze the overall economic health of a country, such as GDP, the gross domestic product, the same thing we studied at high school, unemployment rate and inflation. For example, we'll go deeper into this, but let me just quickly give you a scenario. If a country announces that they are going to release a lot of vacancies, or they are going to recruit a lot of people, is it good or bad for the country? Good. It's good, ne? Who doesn't like employment coming in a country? Then when such news is being released that a lot of jobs will be created or a lot of jobs were created, it's good for the currency, for the country. And when it's good for the country, we expect that currency of that country to do very well. And as traders, when we hear that maybe in Australia, they have recruited a lot of people, you expect that in the future, in the near future, the Australian dollar will do better because they've recruited a lot of people and their economy will boost in the near future. What you do is you buy the Australian dollar. But if you hear news that they have retrenched a lot of people or they have fired a lot of people, it's bad for the currency, bad for the economy. We expect that their currency will do bad. What do? You sell that currency. That is what you do with, and that type of analysis, when you do your analysis based on news events or information that can possibly affect the economy and it can possibly affect the exchange rate of a currency, that is what is known as fundamental analysis, but we'll look at it in detail at a later stage. And then we have interest rate differential. Interest rate differential is the difference in interest rates between two currencies in a currency pair. It's a key factor influencing currency value and can affect traders' decision. So this one, we'll skip it for now. You'll understand it later when we'll dive into fundamental analysis. But interest rate differential also affects swap. I wish we had open trades. Let me just give you the theoretical part of the interest rate differential. What usually happens is when you use leverage, remember leverage, you are given a loan, and when you are being given that loan, you will be using it to trade, leverage, okay? When you trade, you either buy and sell. When you buy, you are buying a certain currency and selling a certain currency simultaneously. If you use leverage and go buy a currency with high interest and you sell a currency with low interest, you will be paid overnight, swap. That is what is known as swap. You will earn swap because you went to go borrow money and you have invested it into a currency that have a high interest, high return, okay? Then you'll be paid swap. But if you are to borrow money, that is, we borrow through leverage, remember? And then you go sell a currency that have high interest. You sell, you go against a currency that have high interest. You buy a currency that have low interest. You will be charged swap. Okay? You will be charged swap. So when you will see overnight, every time if you have to buy Euro USD, you don't close it today. Maybe you hold it for a few days. Every night, you will see that you will be charged maybe a -5 in your account at every 11 o'clock when the day will close. That is what is known as swaps. And it's calculated by the interest rate differential. They compare the interest rates in the currencies that you have purchased or you are trading. So that is interest rate differential. And then we have carry trade. Carry trade, it's a trading strategy where investors borrow in a currency with low interest rate and invest in a currency with a high interest rate to profit from the difference. Basically, it's the opposite of swap. You want to borrow when there's low interest rate, you go and invest somewhere with high return. It's a carry trade, okay? And then we have hedging. brokers, we have to understand not hedging, arbitrage. I'm not sure if it's here. It works hand in hand with hedging. Hedging is basically it's a risk management strategy used to offset, that is to reduce potential losses in one investment by taking an opposite position in another investment. Okay, what do we mean by this? Mostly with hedging, in our case, is when we buy and sell at the same time. You are allowed to buy and sell at the same time. Why? What usually happens in my case, I'll give you a quick example. Let's say you want to sell here, okay?
Here's the other one. All right, man.
Let's say you want to sell here, but then the problem that you have, after you sell, the price goes in profit, later it starts buying. What do you do if you have done your analysis that it's okay, the price will buy maybe until here, then it will start selling again. What will happen is when you are here, maybe you are in profit of a $20, you sold here. When you are here, you are in negative $20, for example, but you know that it will go until negative 50 maybe before it will come back again. To neutralize this movement, instead of you getting out here, or instead of you holding a loss until somewhere here, while you are holding a sell here in a loss, if your prediction is it will buy a bit before selling, you don't have to close this sell position. You can buy it maybe with the same lot size so that when it's here, you will not make any profit, you will not make any loss either. So in that case, you are reducing the risk. When you buy and sell at the same time, based on your conditions, it's known as hedging, okay? And then when the market comes here, you can now drop the, you can drop the buy position, whatever reason, however you want to manipulate it now based on your analysis. And then you keep holding the sell and so on. But you have reduced this loss that was supposed to occur there. That is known as hedging, okay? And then technical indicators. We'll move to technical indicators very soon. It's a mathematical calculations or statistical tools that are used to predict or to forecast future price movement based on historical price and volume data. Common indicators include the moving average, RSI, MACD, Bollinger Bands, Fibonacci retracements, and so on. You can name them, okay? Then we'll move to chart patterns. These are visual formation on price charts that can indicate potential future price movement. It also indicates reversal sometime. Example, we have head and shoulders, triangle formations, flag patterns. We'll look at those things soon. Forex signals. What are Forex signals? Some of you when you enroll for mentorship, you were not sure if you should enroll for signal, if you should enroll for mentorship or both. The right thing to do is to first start with mentorship. What is a Forex signal? These are recommendations or alerts provided by analysts or automated system, robots, for example, though I don't recommend robots, indicating when to buy or sell a currency pair, often based on technical or fundamental analysis. Okay, when you expect someone to do analysis and the person tells you when to buy and when to sell. So those are what are known as signals in the Forex market, okay? And then we look at a trend. A trend, the general direction in which the price of a currency pair is moving. If the price is going up, we say it's trending up. When the price is going down, we say it's trending down. Identified as upward, bullish, or downward, bearish, or sideways, range-bound trend. And then we have stop-loss hand. Stop loss hand is mostly when you sell, for example. Let's say if you are to sell here. Where can I give you a clear example of stop loss hand? Okay. Okay. Let's say we are here. This one is not so beautiful. Let me try to look for a clear stop loss hand example. Let me try to move to H1 time frame.
Go to Papa.
Hey, why am I struggling to find a stop loss hand? Okay, let's try here. No. Okay, let's see here. A stop loss hand, it's mostly when you feel like someone is watching you. We have a message in the chat room. What do we have here? Okay, someone joined late. Okay. So what will happen here is, let's say if you are doing your analysis, then you buy here for whatever reason. Then the market goes in profit a bit and then it comes back just to take out your stop loss. If you are to set your stop loss here, just to take out your stop loss, then it goes in your direction. When the market just goes a bit, just to take down your stop loss, and then it goes in your direction later without you being there. That is known as a stop loss hand, okay? Where is it? It's here. It's a phenomenon. It's a phenomenon where traders push the price of a currency pair to a certain level to trigger stop loss order from other traders, leading to increased volatility. Mostly it's market makers that like doing this. You'll understand later that if you buy when your stop loss will be hit, it's like you have automatically entered a sell position, an opposite position, and so on. For some reason, traders or market makers do these things to trigger other traders' stop loss to allow them to execute their trades to their advantage. Okay. The news trading is more of fundamental, a strategy where traders take position based on anticipated market reaction to news events such as economic reports or geopolitical developments. Scalping. Scalping is when it's a short-term trading strategy focused on taking profits from quick trades. When you want to go in the market quick, maybe you go in and then after 5 minutes you jump out, you take your profit fast. You don't want to stay for long in the market. That is scalping, okay? Typically holds for a few seconds or a few minutes. Then we move to swing trading, a trading strategy that involves holding positions for several days. Maybe you buy on Monday, you hold until Friday to capitalize on expected price moves based on technical and fundamental analysis. That is known as swing trading. And then the risk to reward ratio. It's a measure used by a trader to assess the potential profit of a trade against its potential losses. A favorable risk to reward typically has a value greater than 1:1. Risk to reward is when you risk a $10. For example, you target to make maybe a $2, a $20 or more. This is an example of a risk to reward ratio. Let's do this. This is what I did. If you are to trade with TradingView, there are automatic tools that you'll be using to measure risk to reward ratio. In this example, if I try to buy here, okay, it's a tool that you find on TradingView. It's usually just around there. In this case, you can use this if for a long position, when you want to buy, you just click it, you press where the market price is. If you click there, What will happen is it will indicate two colors. The red color, that is your danger color. That is how much you lose if the price to get there. The green color is the blue color is the profit. It's the profit zone. Meaning, if you are to buy now and set your stop loss here, as we speak, when you use this tool, the risk to reward ratio by default, it's a 1-to-1. If you are to buy there, if you check here, it's written risk reward ratio, it's a 1. Meaning, if you are to buy here and you set your stop loss here, you're going to lose a $10. If you are to make profit, you're going to make a $10. So that is a risk to reward ratio of a 1-to-1. Okay? And then what will happen is, if you are to move your stop loss here, you will see that the risk to reward ratio will automatically adjust as well. Like now it's at 1.4. So if you are to put your stop loss here, and then if you are to increase your take profit area to the higher side, if you are to increase it, it will automatically calculate it that if you are to put your stop loss here, you enter here and you take profit there. The risk to reward ratio is 1-to-2. We usually say 1-to-2, meaning if you are risking a $10, if you are using a $10 stop loss, when the price will reach here, you are going to make how much? How much you're going to make?
Is it not 20?
Yeah, it's 20. And then if you have to use a risk reward ratio of 1-to-3, for example, like this. If you have to risk a $10, you're going to make how much?
30.
Yeah. And then the correct risk to reward ratio is it should be from 1-to-1 and above. My recommendation is a 1-to-2 and above. That is what is known as risk to reward ratio. Okay. And then we have market sentiments. Last but not least, we have market sentiments. Market sentiment is the overall attitude of traders in the market, which can influence price movement. It can be bullish or bearish or neutral based on news indicators and other market dynamic. Market sentiments is there are websites that you can go to. I will share them later in detail when we will trade practical. We'll look at where to get news, where to get market sentiments. But in short, if you have access to information on how many traders have bought Euro USD, there are websites where you can go to. It can show you that maybe 60% of traders have bought Euro USD, 40% have sold. And then you make your trading decision based on the majority or the minority. That is on what others are doing. That is known as market sentiments, okay? So these additional terms, we just learn them because it provides more comprehensive understanding of the Forex market and its trading mechanism. So
Yes.
from now on, when I speak about stop loss hunt, news trading, volatility, I expect you to be on board. So those words, they are all on the group. So for tonight, that is what I wanted us to look at. And then for those that just came through, I made an announcement that this week things might not be smooth. We will have lessons, okay? That is number one. But the issue is over the weekend, we got robbed in our office. It was an armed robbery. All our laptops were gone, meaning I lost all the recordings, all my slides. I'm using a brand new laptop. So I need you to bear with me, especially this week, because I'll be developing materials from scratch. So if you see me teaching with things that are not really in order, just bear with me. Hopefully by next week we'll be back on our feet properly. That is just another. And the second announcement, if you missed the lesson last week, so unfortunately we do not have the recording. If we didn't upload it on YouTube, then we lost it as well. So I need you to bear with me as well, but we will have lessons until on Thursday, so we are not going to miss any lesson. For tomorrow, we are going to start with candlesticks, introduction to candlesticks, Japanese candlesticks. That is what we'll do tomorrow, okay? That is what I had for you tonight, unless you have questions on it. Questions on what we
Yes.
just covered?
Yes, good evening, sir.
Yeah, I say I'm going to ask based on the hedging method.
Okay, let's give
Uh,
Grace a chance, then we can move to
all right.
Marvin. Yeah, Grace.
Yes, can you please just repeat about the I think the swap and the carry trade? Because you said carry trade is the opposite of swap or something like that. If you can just repeat what swap is and carry trade.
A swap, ne?
Mm-hmm.
When you be trading, just that I don't have MT5 on this computer yet. Let's say if you have to buy Euro USD tonight, ne? And then you don't close it, you hold it until tomorrow or until Friday. What usually happens is every night at 11 o'clock, you will see, based on the lot that you have used, you will see either you will be deducted maybe a $3 every night, a $3, $3, $3. Then you'll be wondering what is happening. It's like charges every night. When the day changes, they charge you. Or every night you'll earn maybe an extra $1. It will be in a separate column, not where your profit and losses are. It will be a separate column, written swap, $1. Tomorrow you'll see swap, $2. After 3 days swap, it's a $3. You either earn or you'll be charged. What is this swap? Is it clear there so far?
Yes, it's clear so far.
What usually happens, remember when you use leverage, we said it's borrowed money, remember?
Yes.
And when you borrow money, if you borrow money from me or from someone, usually that money comes with interest. You pay it with interest, right?
Yes.
So the same with Forex. When you use leverage, it's borrowed money. It's not for free. You pay interest. How do you pay interest? When you borrow money, after you borrow money, what are you going to use it for? If you borrow money and then you go and buy Euro USD, they compare between Euro and USD. In their original countries, let's say Euro, it's used in Europe, and then in US dollar, it's used in USA. In Europe and in US dollar, in USA, which country have high interest? Meaning interest, these are things that are affected by repo rates and then the interest rate itself. Maybe interest rate here is 10%, and then here in the other country, the interest rate is 7%, for example. Remember when you are trading, you are buying and selling. When you borrow money and you go buy a currency with high interest and you go sell a currency with low interest, you will be paid for doing that because you went to go and invest in a currency with high interest. You will be paid swap. Is it correct? Is it clear there?
Yes.
Meaning every night you'll be paid. If you do the opposite, after using leverage, which is borrowed money, you go and sell a currency with high interest and you go and buy a currency with low interest and you hold that position every night, you will be charged swap because you are using borrowed money. You'll be punished for borrowing money and you go invest in a currency with low interest and you go sell a currency with high interest. You pay swap. So every night you'll be seeing a small negative on your account accumulating. That is swap. Is it clear?
But just hold on. You had first said when you buy a currency with high interest and sell with a low interest, that's swap. Or is it that when you sell a currency with high interest and then buy with a low interest? Which one is which? So is it that you buy at a higher with a currency with a higher interest rate, or is it selling with a high interest rate? I mean, selling at a lower interest rate.
Who can help me explain to her what is swap? Who
I just need to
understands
know
swap?
I just need to know which one are we buying at the higher interest and then selling at the lower interest, and then with the carry trade, which one are we selling with a high and a low? I don't know if
What I
my
say,
question is clear.
Grace,
Mm-hmm.
swap, ne? Number one, whether you buy a high interest or a low interest, They are both swaps. The only difference,
Okay.
this swap, either,
Uh,
uh-huh,
Mr. Slinter, it's like this. The money which is charged, like if you, how is it again?
If you
You
overnight,
said like this is the amount of money which is charged when a trade like it leaves over. It
Grace,
stays there for a night, and then these are interest charged when you borrow money.
Yes.
maybe let me use a good example, ne?
Okay.
If you borrow money from me, ne? And then you go
Yes.
and invest it somewhere with a high return. Will you be paid or you will be charged?
I'll be paid.
You'll be paid, ne?
Mm-hmm.
It's the same with swap. When you borrow money and you go and buy a currency with a high interest, you will be paid. What will you be paid? You will be paid swap. Meaning you will in a reward for in borrowing money and investing in a currency with high interest. Is it clear there?
Yes.
The opposite is also true. When you borrow money and invest in a currency with low interest, what is going to happen?
You're gonna lose.
You're going to lose, meaning you will be charged swap. So what I'm saying is swap comes in two ways. It's either it's you that they will pay as a reward for investing in a currency with a high return, or it is you that they will charge as a punishment for borrowing money and invest in a currency with low interest. Is it clear there?
Yes.
Do we still have questions or it's clear now?
And then the carry trade, because I thought you said carry trade is the opposite of now the swap.
No. Carry trade,
That's something else.
yeah. Carry trade,
Okay.
it's for example, a typical example, if you have two banks, for example, ne, offering different interest, maybe this one is operating at 2% and the other one is operating at 5%. When you borrow money from NetBank and then you have to return it at 2%, you go and invest in Standard Bank, whereby they are paying you. If you invest with them, they will pay you 5%. What are you gonna do? You borrow $100, maybe a 1,000, and then if you borrow money from let's say NetBank, you have to return it with a 2% interest. That is, let's say 20% interest, for example. That means you have to return that 1,000 with an extra 200. Is that correct? Grace,
Okay. I get it
20%
now.
of a
Thank you.
1,000 is a 200, right?
Yes.
Yeah. Let's say NetBank is giving a loan at 20%, okay? What do? You go borrow a 1,000 from NetBank, and then when you will return it, you have to return it with an extra 200. Is that clear? 20%.
Mhm.
And then if you
Yes.
know that Standard Bank, if you invest money with them, when you will get it back, you will get it back with an extra 30%. How much is 30% of a 1,000?
Oh. 300.
300. Now, carry trade is when you go and borrow a 1,000 from NetBank because they have a low interest. You go and invest it in Standard Bank at a high return. Meaning you go borrow a 1,000 from NetBank, you go invest it in Standard Bank. When Standard Bank will pay you a 300 extra, meaning Standard Bank will pay you a total of 1,300. You take a 1,200, you take it back to NetBank with their profit, and you keep $100. You have made profit, isn't it? When you identify two markets, One have low interest, the other one have high interest. You go borrow money where there is low interest, you go invest it somewhere with high return, with high interest, you make profit of the difference. That is carry trade. Is it clear then?
Yes, it's clear.
Okay.
Yes.
All right.
All right, thank you.
Welcome. Then we have Marvin. Marvin, come through.
Yes, the hedging method. You say it's when you buy and sell at the same time. But I heard about another strategy which is also called the hedging method, where you say you sell at 0.6 and then you go in again at the same pair, and then you make it 0.5, then it becomes 0.1. Is that also hedging?
No. Let's say you sell at 0.6, ne?
Mm-hmm.
And then after that, what do you do?
You go back inside and at the same pair, you make it 0.5 again. Then it becomes 0.1.
You sell again.
Yes.
No, that is not hedging.
Oh.
That one, I will say it's scaling in. Scaling in when you add to your position. You buy, you add more buys. That is scaling in.
Mm.
Hedging is when you do the opposite of what you already did. If you buy and then you sell at the same time, you do the opposite. That is hedging.
Yeah. Oh,
Yeah.
okay. All right, it's fine.
Yeah. And then the carry trade, it's also in line with arbitrage. Arbitrage is when you identify two markets and then you buy in this market at a low whatsoever, you quickly go sell in a different market, you make profit. That is arbitrage trading. So, all that. Marvin, is it clear there?
Yeah, it's clear. Yeah.
Okay. Any other question?
So you said you don't recommend people to use robots, eh?
I don't recommend robots. I feel a human always outperforms robots. Robots, account management, investments,
Because I was just watching one guy that does that.
Pardon?
No, I was just analyzing how one guy was doing it on another group, but then it took an hour to go into what he predicted. For example, he said sell, but it only started selling after an hour.
That one, it's usual, it's normal, because no one can really control the market. Whoever is saying sell, whether it's you or someone else, it's just recommending based on analysis. But the market, just because you say sell, it can't move in your direction. You remember there are millions of other traders. The market cannot adhere to you. The market does what it wants in most of the time. So for most of us, we just try to align with that.
Okay.
Yeah. Any other question? All right. If there are no questions, then thank you so much. We will meet tomorrow at 8 o'clock. I'll try to be on time, okay? Where we'll have a look at Japanese candlesticks, okay? These things that we see here, some of them that looks like candles, red, some of them they are blue or green. What are these things and how do you interpret them? They mean something in the Forex market. That is what we're going to look at tonight, okay? Have a blessed night ahead. We'll see you tomorrow. Good night.
Good night.